Hey everyone, I'm really pumped to have you all here today. We're diving into a super important concept in finance, the time value of money. Whether you're saving up for something big, planning investments, or just trying to make smart money moves, understanding TVM is a game changer. Let's get started and see why a dollar today is worth more than a dollar tomorrow. Imagine you find a $100 bill on the ground today. What can you do with it? Sure, you could spend it, but you could also invest it. By investing, you could earn interest and watch your money grow over time. This potential growth is why money has a time value. The whole idea behind TVM is that a buck today is worth more than a buck tomorrow because today's money can be invested and earn returns. So, the sooner you get your hands on cash, the more valuable it is. This concept underpins almost every financial decision we make, from personal savings to corporate investment strategies. Now, let's talk about fixed income instruments like bonds. These are essentially loans made by investors to borrowers, usually corporations or governments, who promise to pay back the principal amount along with interest. The value of these instruments depends significantly on the timing of cash flows. Receiving money sooner is more valuable because you can reinvest it to earn additional returns. This is where the discount rate comes into play. The discount rate reflects the risk and return of an investment, helping us determine the present value of future cash flows. To understand this better, let's look at the relationship between present value and future value. The formula is future value at time t equals present value multiplied by 1 plus the interest rate raised to the power of t. For example, if you invest $100 at an annual interest rate of 5%, after 1 year, the future value would be 105. So in this case, $100 today is equivalent to $105 a year from now, given a 5% interest rate. This simple concept is the cornerstone of more complex financial calculations. For continuous compounding, the relationship is represented by future value at time t equals present value multiplied by e, the base of the natural logarithm, raised to the power of the interest rate times t. All right, let's dive into the different types of fixed income instruments and how they work. We'll break it down into 3 main types. Number 1 is discount instruments. These are bought at a price lower than their face value and redeemed at force value at maturity. The interest earned is the difference between the future value and the present value. Present value of a discount bond equals the future value at time t divided by 1 plus the interest rate raised to the power of t. For example, if you buy a discount bond for $950 that matures in 1 year at $1,000, the interest earned is $50. Not too shabby, right? Number 2 is coupon instruments. These bonds pay periodic interest payments, coupons, throughout their life and return the face value at maturity. The present value of a coupon bond is calculated by summing the present value of all future cash flows. For example, a 5-year corporate bond with a 6% coupon rate on a $1,000 face value pays $60 annually. So every year you get $60, and at the end of 5 years, you get your $1,000 back. Number 3 is annuity instruments. These involve regular uniform payments until maturity. They can be used for mortgages, car loans, and retirement annuities. The periodic cash flow equals the interest rate times the present value divided by 1 minus 1 plus the interest rate raised to the negative t. Let's not forget perpetual bonds. These bonds have no maturity date and pay interest forever. They're kind of like the Energizer Bunny. They just keep going. Their present value equals the periodic payment divided by the interest rate. For example, if a stock pays a constant dividend of $10 per year and the required rate of return is 20%, the present value is $50. Perpetual bonds are often used by companies as a form of equity-like financing, without the need to repay the principal. Now, let's switch gears and talk about equity instruments like stocks. These represent ownership in a company and entitle investors to dividends. Unlike fixed income instruments, stocks don't have a set maturity date. They can keep going as long as the company exists. Their valuation involves discounting future cash flows using an expected rate of return. There are three common approaches to valuing stocks based on dividend cash flows. First approach is constant dividends. The stock pays a consistent dividend indefinitely. Present value equals the dividend divided by the interest rate. Here D is the constant dividend. This is similar to the perpetual bond formula. If a stock pays a $5 dividend each year and the required return is 10%, the present value is $50. Okay, the second approach is constant dividend growth rate. The dividends grow at a constant rate. Present value equals the dividend times 1 plus the growth rate divided by the interest rate minus the growth rate. Here, R must be greater than G for the formula to work. For example, if a stock pays a $5 dividend expected to grow at 2% annually and the required return is 10%, the present value as calculated by this formula would be 63.75. Third approach is changing dividend growth rate. Here, dividends initially grow rapidly but slow down over time as the company matures. This is modeled using a two-stage approach. For stocks with changing growth, a two-stage model is common. It begins with a high growth rate for a few years, followed by a slower, constant rate. The formula is like this. Now, we're going to talk about a very interesting concept in finance, implied return. The market price of an asset often reflects the implied return or growth rate. First off, implied return is essentially the return you expect to get from an investment if all the future cash flows happen as promised. For fixed income instruments, the implied return is the yield to maturity, YTM, which equates the present value of all future cash flows to the current market price. This concept helps us understand what the market expects about future interest rates or returns based on current prices of financial instruments. Let's start with some basics. Imagine you know both the current price and future cash flows of an investment. For instance, you might know how much a bond costs today and how much it will pay you in the future. With this information, you can calculate the rate of return that's implied by these prices and cash flows. Why is this important? By solving for the implied return, we can get a sense of what the market as a whole expects about future returns. It's like reading the market's mind. Let's look at an example involving a discount bond. Imagine you buy a bond that promises to pay back the principal amount at maturity, but you buy it at a discount price today. The difference between what you pay and what you get back at maturity represents your implied return. Let's say you're looking at a French 10-year zero coupon government bond. When it was issued in 2017, the bond was priced at €84 per 100 euro principal with an annual YTM of 1.75%. Now, suppose an investor purchased the bond in 2017 for 5-year investment horizon. Fast forward 5 years, and the bond is now trading at 94.5 per 100 euro principal. To find the investor's implied return over the 5-year holding period, we use this formula. The interest rate equals the future value divided by the present value, raised to the power of 1 over the number of periods minus 1. So over the 5-year holding period, the implied return is 2.38% annually. This return is because the bond's price increases from 84 to 94.5. Now, let's say another investor bought this bond in 2017 and held it until maturity, 10 years in this case. So for this investor, the implied return over the 10 years is 1.75% annually. Pretty interesting, right? This shows how the bond's price movement and yields interplay over different holding periods. For stocks, the implied return is the sum of the expected dividend yield and the growth rate. The interest rate equals the dividend divided by the current price plus the growth rate, which relates a share price to its earnings per share. So what's the deal with the PE ratio? Simply put, it tells us how much investors are willing to pay for each dollar of earnings. It's a go-to tool for comparing stocks or indices like the S&P 500. The price-to-earnings ratio can also be used to infer the required return or implied growth rate. All right, let's talk about the implications. Given the price-to-earnings ratio and the dividend payout ratio, we can figure out either the required return or the implied dividend growth rate, assuming we know the other one. This analysis helps us compare a company's expected growth with its historical growth, which is super helpful for making valuation assessments. Now, there's something called the forward price-to-earnings ratio, which relates the share price to its projected earnings for the next period. Here's a neat little formula for it. The price-to-earnings ratio in the next period equals the dividend in the next period divided by the earnings in the next period, all divided by the required return minus the growth rate. In simple terms, a higher expected dividend payout ratio and higher growth will boost the forward price-to-earnings ratio. On the flip side, a higher required return will bring it down. Why does this matter? Well, the implied return, growth, and price-to-earnings ratios give investors valuable insights. They help us make informed decisions and evaluate stocks based on expected growth, dividend yields, and required returns. For example, if a company has a high PE ratio, it might mean investors expect high growth in the future. But if the growth doesn't pan out, the stock could be overpriced. On the other hand, a low PE might indicate the stock is undervalued, which could be an opportunity if the company has strong fundamentals. Finally, let's discuss the cash flow additivity principle. This fancy term means the present value of a series of future cash flows is just the sum of the present values of the individual cash flows. This principle ensures there's no risk-free profit without transaction costs. Using cash flow additivity, we can calculate implied forward rates. For example, if we have a 1-year bond yielding 2.5% and a 2-year bond yielding 3.5%, we can find the implied forward rate for the second year. Solving for F, we get an implied forward rate of approximately 4.51%. This principle is also applied in calculating forward exchange rates to ensure no arbitrage opportunities. It's all about making sure that there's no risk-free profit to be made just by switching currencies. Imagine you have $1,000 to invest for 6 months. You have two options. Invest in a U.S. Treasuries bill or a Japanese Treasury bill. Let's set the scene with the following details. The current exchange rate is $1 US equals 134.4 Japanese yen. The 6-month risk-free rate in the US is 2%. The 6-month risk-free rate in Japan is 0.05%. First, let's see what happens if you invest in a U.S. Treasury bill. At time 0, you invest $1,000 at the U.S. risk-free rate of 2% for 6 months. In 6 months, your investment grows to approximately $1,010. So after 6 months, you receive $1,010.05. Now, let's look at what happens if you convert your $1,000 into Japanese yen and invest in a Japanese Treasury bill. At time 0, convert $1,000 to Japanese yen at the current exchange rate. $1,000 multiplied by 134.4 equals 134,400 Japanese yen. In 6 months, your investment grows to 134,433.6 yen. Now, we need to convert the yen back to US dollar at the forward exchange rate set today. Let's assume the forward rate is 133.096 yen per dollar. So, after 6 months, you receive $1,010.05. Notice that both strategies yield the same amount, $1,010.05 after 6 months. This balance ensures there are no arbitrage opportunities. If the forward exchange rate were set differently, say higher or lower than 133.096, investors could exploit this difference to make risk-free profits. All right, folks, for our last topic of the session, let's dive into option pricing using cash flow additivity. This concept is key for establishing no arbitrage pricing for options, which ensures that there are no risk-free profits available from market inefficiencies. The cash flow additivity principle involves creating replicating portfolios to match future cash flows with a risk-free asset. This means we create a combination of assets that mimics the cash flows of an option, ensuring no arbitrage opportunities exist. Essentially, this helps us determine the fair price of an option. One key element in this process is the hedge ratio, which is the proportion of the underlying asset used to determine option prices. This ratio helps us balance the portfolio to replicate the option's payoff. Let's dive into an example to illustrate how this works. Assume an investor is considering buying a call option on a stock. Remember, a call option gives the investor the right, but not the obligation, to buy the stock at a certain price on a certain date. To use the cash flow additivity principle to price the call option, the investor would first calculate the present value of the call option's payoff in each possible scenario. The present value calculation helps us understand how much future cash flows are worth today. The investor would then sum the present values of these payoffs to determine the price of the call option. The price is essentially the total present value of all possible outcomes weighted by their probabilities. That's a wrap for today's session on the time value of money. Understanding TVM is necessary for making smart financial decisions, whether you're evaluating bonds, stocks, or any other financial instruments. Just remember, the sooner you get your cash flows, the more valuable they are. Keep practicing the examples from your CFA curriculum to nail these concepts. Thanks for hanging out with me today, and I'll catch you in the next session.